little hard to come after the cannabis panel, but they'll be giving out brownies after this, so if everybody listens to us, we don't have. They promise not to start serving until afterwards. So I want to take a moment to introduce everybody here today. I'm Mark Elenowitz. On the end here is Jeff Houston. We have Paul Dorfman and Nimish Patel. And we have a wide panel today from accountants to the New York Stock Exchange, to securities attorney, and I'm a banker with Tri-Point. And what we're going to be talking about is Reg A plus and how that's a little bit different from RTOs and what everybody's been used to over the last couple of years of doing a reverse takeover. And the marketplace, and I think a lot of the professionals don't truly understand what Reg A plus is. It's something that came about in March 2015, in March of 2015. The SEC finally approved what was known as Reg A plus. And that enabled small cap issuers to go out now and raise up to $50 million from non-accredited investors. And this was a major move and a really exciting aspect of the Jobs Act that came out in 2012. And it actually came into effect really in June 2015, where issuers could now go. Sorry about that.
No, that's on us. I apologize.
So issuers could now go out, use social media, use Facebook, Twitter, and go out and advertise an offering during the filing process, before the filing process, and then once it's qualified, which would be the equivalent of being effective like an S1, and be able to market now across the entire spectrum, the non-accredited as well as accredited investors. And this is something that we like to say, bringing back the small cap IPO. It has all the benefits of doing a full S1, but no quiet period. So all the issues that you have when you're doing a traditional underwriting, where you have to follow the rules and you can only say certain things and you can't leave documents behind, now all that's out the door. So Wall Street has finally caught up with Main Street. And a lot of people call this crowdfunding, because originally crowdfunding was what was known as Title III of the Jobs Act. But this is more of what we call crowd finance. So it's able basically to now take these companies and be able to go out to, as I said, the general community, raise capital, and not only have those shares be registered for resale, but more importantly, be able to have them trade on a national securities exchange. And that's why Paul's here to be able to talk a little bit about that. So we're going to go over, first we're going to talk with Nimish today about the legal aspects of it, what's necessary in order to do a Reg A versus a RTO, and what the benefit is not only to the shareholder, but to the issuer.
Great. Well, I think after just hearing the cannabis panel, you kind of realized all that excitement that they had about this little industry. And as securities lawyers, I think we were all excited when the Jobs Act passed too. We thought crowdfunding and Reg A plus was just going to be opening up the floodgates for financing. Unfortunately, I think the jury's still out. I think it's there's still a lot of education that needs to go on, and I think a lot of people are starting to, they still need to understand this a little bit better before they kind of jump in. But we are seeing a lot of activity in this particular space. What the reverse merger used to be sort of the weapon of choice, I think in a very near future, Reg A plus will be the weapon of choice for many companies to sort of access public finance in a way that will provide liquidity for their investors. And in the end, that's really the kind of the main issue why people are going to gravitate towards this. Why did they do the reverse merger? Because after the dot-com bust, investors no longer wanted to invest in private companies and hope for an exit 3 to 7 years from now. They wanted to know that once they make their investment, they had an immediate capital liquidity or an exit strategy built in. With the reverse merger, as many of you guys know how that works, once you identify a public shell, you do your due diligence, you merge the operating company with the private company, and the operating document is usually a share exchange agreement, which talks about all the terms and how the ownership is going to work out. And then you make your first filing with the SEC under what they call a Super 8K, which basically is a full disclosure about the company, its business, management, ownership, any kind of related party transactions. And that gets up into the public domain under the EDGAR website, under the SEC's website. And so the whole idea is that you're creating transparency, you're ultimately providing liquidity, and once that liquidity is brought forth, you've got investors who are now more passionate to make that investment. Now, you have Reg A plus, which sort of does something very similar, but it takes away the shell now. You no longer need to do that. You can simply file a Form 1A, which is very similar to what a Form 10 used to do, but much with less disclosures. And once that gets effective, the shares are free trading, and ultimately a market can develop either on the New York Stock Exchange or NASDAQ, or perhaps even or at the OTC markets. And so it's going to provide a nice substitute for what people were using the reverse mergers for. It just needs a little bit more time to develop.
Jeff, maybe tell us a little bit about the accounting that goes into it. It's similar, but there are a little bit of differences in terms of reverse merger accounting versus what this is.
Yeah, so basically, most of the advantages and arguably disadvantages associated with Reg A aren't really impactful when it comes to the audit side, I don't believe. The primary differences between doing, say, a reverse merger versus doing a Reg A offering is when you come into a reverse merger, as Nimish pointed out, you're going to file a Super 8K, which provides pro forma financial statements as well as audited financial statements for the accounting acquirer, and you end up having effectively to have to audit two entities. Many times the shells that are the targets of the reverse merger, they may be delinquent, they may have some issues associated with it, whether it's environmental liabilities or legal liabilities, or just some business practices that are going to get, or business functions that are going to get moved out in existing smaller business. So that the RTO presents some of those complexities, as well as I lost my train of thought on that, but the RTO presents some complexities that you don't necessarily have in the Reg A. It's a very short process, typically speaking, where you're taking the operating entity that you're registering, and you are required to provide 2 years of audited financial statements, or alternatively from the date of inception. One of the pitfalls that we've seen in some of the Reg A's that we've done is the typical things that we often run into with companies that are new to being public, and that is that they don't come prepared with a good set of books. They don't particularly understand the regulatory market in which they're going to enter. So we spend a lot of time educating our clients on the revised reporting requirements, which were reduced over a reverse merger candidate. So when you're a Reg A filer, you have reduced filing requirements, particularly semi-annual filing requirements or quarterly filing requirements, and you're not subject to the same 34 Act filing requirements that you are in a reverse merger or traditional S1.
So one of the things about Reg A Plus, which is really exciting from our standpoint, is that not only do you have to go through this audit process, but as he said, that there's semi-annual filings. So you have a choice. You can either become what's known as a 34 Act company, where you have your Ks and your Qs and you have your regular reporting. But you can also have the ability under Reg A Plus to be able to file semi-annually. And then it's a simplified filing process that enables some of these newer or earlier stage issuers not to go through the expense of being a full reporting issuer. The downside, though, of Reg A Plus is that it was originally created for these issuers to be able to trade on the over-the-counter market. And as many of you know, there's problems with the over-the-counter market now in terms of being able to provide liquidity to the issuer. So not only is it a problem being able to trade in the secondary market, but there's also a problem being able to deposit those securities and be able to have them trade because of something known as designated securities, or stocks that are under $5 a share that trade on the NYSE under $3 or the OTC, or sorry, NASDAQ, but also all shares that trade in the over-the-counter market. So when we were looking at Reg A Plus, we were trying to figure out how do we bring this back to be a small cap IPO? How do we mimic what we're looking at in terms of the traditional underwriting, where you have syndicate members and people that are used to settling trades in a normal capacity, going through the syndicate desk or going through DTC. And we came up with the idea, and it took a long time of talking with Paul in the New York Stock Exchange, to basically make Reg A Plus look, act, and feel like a traditional underwriting. And the benefit that you have is not only do you have the blue sky ability to market the security during the Reg A process, but once the stock is then, once the financing is complete, you file what's known as an 8A. And with that in place, you're now a 34 Act issuer. So you can open for trading the next day onto the NYSE or onto NASDAQ and be able to give the aftermarket liquidity. And that's something that we're doing with our clients. So maybe, Paul, you can tell us a little bit about the difference between an RTO and the seasoning rule and some of the regulatory changes around that, and then the beauty of what we've been able to create with Reg A+.
Right, so we'll list at the NYSE, we have two platforms, right? We have the NYSE and we have the NYSE MKT, and that's our growth company platform. And that's where we tend to see the smaller companies. We've seen some reverse merger companies, some OTC uplistings, whether they were reverse merger or not. And of course, we hope to see some Reg A companies too, so we're really excited about that. So in one sense, however a company finances itself, we want to list them, right? As long as they meet our initial listing standards. And so the reverse mergers have been around for a while. We know some of the pros and cons with that. It can take a long time, right? You have to complete your transaction, and then you have to file your Super 8K and wait for a full fiscal year end to complete after the year of the Super 8K, and then, begin the uplisting process. And then in terms of meeting our minimums, right, to get listed, one of the minimums, of course, are stock price. And so for reverse mergers, you have to hold that stock price for 30 out of 60 days, right? So there's some things that can really make the process take a little bit longer. And this is assuming that with that reverse merger, you haven't done that $40 million underwritten public offering, which is something that accelerates in your reverse merger deal and can uplist instantly. But that's a tall order, right, for some of these, for almost all of the companies that have done reverse mergers. So, we're talking to a lot of companies now that have done those, and they're seasoning, right? They're finishing that year of the deal, they're finishing that full fiscal year end after, waiting for the 8K to come out, then get that stock price to the 2 or 3, and for 30 out of 60 days. Not always so, rapid a process, but that's one thing, and that's fine. So with the Reg A, again, we're really excited by it. Of getting listings through that. And if through a Reg A raise, they meet our standards, we can list these companies. So it's really kind of a neat new opportunity for us as a stock exchange. So we're both helping, right? I think the perception of this product, of this mechanism, and those companies that are going to go through, use this mechanism to raise money, we're really excited. So it's new business for us. These are going to be exciting, great, real companies. And, if you've got your $2 or $3, if you've got your shareholder equity, if you've got your market value public float, right? All of these things that we look for in our new listings, again, regardless of how you come to us. If you've got those, right, an 8A is filed, we certify it, boom, right, we trade the next day. And the nice thing about the NYSE is that you've got what we call a designated market maker. For anyone my age or older, you know the term specialist. A lot of people don't know what a specialist is, but it's kind of an iconic term in Wall Street. Anyway, we have those, and we think that those will help in terms of determining a price. Because typically they'll pick a price to do the deal at. And so what happens? You've done your deal, you've raised your money, now you've got to trade. Well, where are you going to trade? Supply and demand will determine that. And that happens with an IPO, any big or small IPO. So we like to have this participant on the floor, we call them, again, designated market makers, that will help elicit order flow, buy and sell side interest on that first day of trading, right? Be a catalyst for trading, put up their own capital, right, long or short, and help that company, right, hit the ground running and get some liquidity into that stock. That's such an important thing.
So one of the things about a reverse merger is it's something that we've all been used to. It's a tool that we've used over the years. It came out of favor the last couple of years because some of the problems that we saw at the Asian market and some of the regulatory changes that Paul just mentioned about the seasoning rule. But I think there's a misconception and misunderstanding to a lot of issuers that are looking to raise capital that they think if they do a reverse merger, they can instantly raise money, not recognizing that they're still raising capital in the traditional Reg B form, which means that you either have to use Reg B 506B, which would be a private offering or a PIPE, or a 506C, which is a generally solicited deal. But the downside of that is you're only marketing to an accredited investor. There's also rules and regulations about when those shares are going to be eligible for resale, whether it's going to be through an S1 filing to register them or an exemption. With Reg A+, you don't have any of those issues because those shares are free trading from day one for the investors that come in. But a lot of the service providers and a lot of the people that are in the shell market or reverse merger market still haven't quite understood what the difference is. So maybe, Nimish, you could talk a little bit about what that holding period is for reverse merger versus Reg A for selling shareholders or existing shareholders, and how it can be liquidated.
Yeah, absolutely. The operative rule is Rule 144. It's a safe harbor rule, Section 401, which basically allows you, if you meet certain conditions, to be able to sell restricted securities. Prior to 2007, it was pretty onerous. You had to met a lot of requirements, filing a Form 144, the volume limitations, the way you have to go about doing that, the sale. Back then, it was 1 year holding period. In 2007, the SEC did provide some amendments to them, relaxed the rule. Basic premise is now it's a 6-month holding period, although you're non-reporting it, it's still a 1 year holding period. But the idea is that in 6 months, it should help a lot of these issuers not go to the burden and expense of filing a resale registration statement on the next one. Those tend to be costly. It takes a lot of time and energy, audits and legal, and therefore, the transaction costs were a lot higher for investors. By shortening the rule, I think the SEC was hoping that a lot of investors could at least wait the 6 months rule. Unfortunately, though, in connection with the reverse merger, because you're so new as a reporting company, the rule requires you to at least be, first of all, you can't no longer be a shell company. You must be subject to the reporting requirements, and you must be current with all of your reporting requirements for the last 12 months. And then after 1 year from the date you file your 8K, are you then eligible to do it? So, investors were frustrated with that concept that they still have to wait this long period of time before they can see a liquidity. The whole purpose of investing in a public company was to have that immediate liquidity. And so I think what we're going to see more and more people are starting to realize maybe Reg A is still the better process now, because those securities are free trading upon receiving them. And if you're trading on an exchange like the New York Stock Exchange, you can start trading the very next day. So it truly is an IPO. You're going through the front door. The SEC doesn't have the same safeguards or these kind of circuit breakers making the investment risk hold remain with the investor for a period of time before they pass it on to someone else. So I think more and more, because of that liquidity reasons, we're going to see a lot more people using the Reg A as a way of raising capital.
So when Reg A Plus came out last year, everybody got excited about it and thought this was the holy grail. That if you were a startup company, an early stage company, you could go out and raise $50 million. But the reality is you can't. And most of the companies that have attempted to do these raises have been really companies that probably shouldn't have been public. We, and this is a little self-serving, but we, over the last 4 years, have created a platform called BANQ to be able to facilitate this. And when Reg A came out, we had 212 companies apply to be on our platform. And I would say 200 of those companies should have never been public. They all thought because they had a great idea and $1,000 in the bank, they could suddenly come out with a $300 million market cap. Or there was some type of technology that was so futuristic that even our professional staff couldn't understand. So how do you raise money using Reg A Plus? It's not for everybody. It's for issuers that have an affinity group. It's for issuers that have a consumer base, that you want to translate those consumers and those customers into shareholders. So it's something that the company and the issuer has to really look at, and it's something that you're going to be able in a 30-second pitch, and that pitch is going to be done electronically. So you're able now, as I said, to be able to use Facebook, email blast, and YouTube influencers, and all of these different channels that were never available to Wall Street to be able now to drive investor interest. So those stories have to be something that makes sense. And the beautiful part of Reg A Plus, as I said, there's something called test the waters. So we can go out, and I can tell you now, 3 of our companies today that we're raising capital for. In a traditional IPO, we could never say a word about it. One of them is here this week. It's a company called Myoma. They're an exoskeleton robotic arm. Somebody with paralysis can use it. If you're a stroke victim, an MLS, ALS, you can use that product now, use your brain waves, and be able to have robotic or mobility brought back to you. That is a perfect Reg A candidate, because that's an issue where somebody has some connection to somebody that has some type of paralysis, And when you see the video, and we use videos of a little boy that's wants to raise his hand at Sunday school and ask a question, you get it. You have an emotional bond. There's been one very successful IPO that's been done under Reg A+, which is called Helio Motors. And I can argue that Helio was a huge success. They raised almost $17 million from 6,700 investors. It was fantastic. They did a great job. They crowdsourced it. They used a lot of their original people that they had reservations from. And these people now became shareholders of their company. The failure, I think, in that particular offering is they didn't use a banker. It went through a process of a learning curve because they didn't understand the ability to deposit securities into a OTC marketplace. So you have a company now that has gone out with a $300-something million valuation that has zero revenue, that needs to raise a lot more money just to be able to open their facility. So the downside to that is you have an unsophisticated community that has now bought that stock. And the question is, when liquidity develops and actually people can deposit the securities, will it actually be able to trade? Another issue that we're doing is a company called Yuengling, and everybody probably knows the Yuengling Brewery Company. This is part of the same family, but it's an ice cream business. Again, you understand it. It's a business that you can see. So with testing the waters, you can go out now ahead of time and see if the marketplace is going to have an interest for your offering. But these offerings are not inexpensive. They require a significant amount of money up front to drive the marketing, to drive that campaign, to drive those issuers to come in to want to buy that security. So again, the misconception of Reg A is that you just put out an email and you put out an escrow account and suddenly everybody's going to fund your account. It doesn't happen. It doesn't work that way. So by utilizing some of the regulations that he was talking about, using what Paul and NASDAQ and the New York Stock Exchange have now embraced, you're basically able now to bring back that small cap IPO. And the other aspect of this, which is really exciting, is that you can actually raise money during the filing process. And you can use 506B or C. And you can continue to raise capital until your offering is qualified. So a lot of these issuers are going through an initial period where you're doing a bridge to the IPO. It converts into the discount of the IPO. So the company can continually raise capital and not have to stop all activities like you would do in a traditional underwriting. So again, Reg A Plus is all the benefits of the full S1, but now you have even more greater ability to raise capital, talk about it, and be able to go out to the community during that period and raise capital throughout the entire offering process. So I'm going to turn it over. We only have 5 minutes left. If any questions, anybody has any. Richard.
So what's holding back, or what's the hesitation for bankers to embrace it and do a Reg A deal that would be maybe an underwritten kind of deal?
So I think the biggest problem with bankers is their compliance departments. Because I think what all of us are trying to get our hands around is it's not necessarily a primary offering. Reg A Plus, we understand the SEC has enabled us to go out now and use this ability or use this Form 1A to raise the capital. And the question is, what happens after the capital is raised? How do you settle the transaction? So a lot of investment banks and a lot of brokerage firms and their compliance departments are used to a regular way settlement. But when you're talking about doing this, this is in essence a best efforts underwriting using a third-party escrow, or if you have technology like we do in some other firms where you're not using escrow. So then you come into the question is, well, is this a registered security? Is it an exempt security? Do I need to go through some of the FINRA regulations, which are determining how those securities were purchased, and can I actually take the deposit? So I think we're seeing a slow adoption. What we saw is there's an offering out there, I believe it got qualified 2 days ago. Freeman Billings and Stifel are now involved in that. So we're starting to see some of the bigger firms start to understand it and accept it. And I think in time it will become the new norm.
How does Reg A change the investor landscape? So we raised, I think you said 6,700 investors. How sophisticated are those investors? And because some of these other companies that are raising through Reg A, I'm assuming a lot of them are not shareholders. They don't have other brokerage accounts.
Well, I'll add, we're definitely seeing a whole new crop of investors that have never invested in companies like these before. We had one particular client, they tested the waters, and they got $5 million of subscriptions in 3 weeks. And they didn't recognize any of those investors, any of those subscribers. They're just new people that had an affinity to what the company was doing. And I think that's the beauty of what this Jobs Act, Reg A Plus was doing is sort of the democratization of capital, allowing other people to get access to deals that they normally would not have seen. The venture funds and all these other private equity funds, they have sophisticated departments and analysts who are able to get these deals. If the regular person could have invested in Facebook, they would be millionaires too, but they don't have those opportunities. And I think crowdfunding and Reg A Plus is finally bringing those people out and giving them a shot of doing some of these transactions. You guys want to add to that too? Sorry.
I can add to that from our standpoint. I don't think the crowd is the solution yet. And I think when you looked at those offerings, that particular shareholder base were primarily unsophisticated investors that had a passion for that particular product. We're using a hybrid approach where we're using traditional syndicate, we're using an institutional approach, and then we're also bringing in the crowd. But you have to remember that even though these investors might have a passion or a feeling that they want to be a part of it, nobody wakes up and wants to buy stock. You still have to sell it to them. Somebody has to get on the phone and communicate that story. And that's where you need to have a broker-dealer or somebody that's licensed involved, because you might attract the interest of that investor. But when you look at the Elio transaction, there was over 44 million of indications, but they closed 17 million. So it tells you there was a lot of drop-off there. And the question is, were people just indicating just to indicate, or were they somebody that wanted to buy but didn't really understand the process and there was nobody there to call them? So I think by using a mixture of both traditional methods and then utilizing the crowd, you'll be able to see those investors actually convert from being an indication to an actionable order.
Why don't you talk about the mechanics of how it works a little? Is there like traditionally a lead investor before the retail people that are going to come in? You said there's no escrow account, so what exactly is happening?
Well, there is escrow that's used.
There is an escrow.
Right. So I can
And
take.
is there a timeline that for closing?
Yeah, so we're in an offering right now during the test of the waters phase. So what happens during that point is that you're out there soliciting interest, but you can't actually confirm the order. So in order to close a transaction, the order you must have a qualified offering. And that must either go through an escrow account or, as I said, use
There's like a
technology.
minimum.
Well, that's another failure that we saw. So back to Richard's question, why aren't we seeing some of these deals get done, or why aren't broker dealers getting involved? The ones that we saw initially jump into the marketplace were entrepreneurs that were being advised by platforms that now were registered and not from traditional Wall Street means. So they were getting these valuations, and they all had the confidence. I can't tell you how many CEOs said, I'm the next Facebook, I'm the next Twitter, and I'm worth 300 million, so I'm so confident I'm going to set my minimum to be $10 million. And they raised $2 million. The good news is they raised $2 million. That's fantastic from the crowd, but they couldn't take it or close. So we advise our clients not to use a minimum. Use a threshold that's necessary. In order to list on the exchange, there are certain minimum net equity standards that have to be met, and that's where you set those minimums. So what goes through the process is you do a filing of the initial Form 1A. You can either file confidentially or you can come out of stealth mode. In our circumstance, with my client, we filed confidentially. And we did that so we could go through some of the comments. And that usually takes the entire filing process. And Nimish, you can probably talk a little bit more about this. But we're seeing anywhere from 65 to 75 days. You're then qualified. And then you begin your marketing period. And that's when you really start to drive that traffic. So do you have an institutional lead? Probably not. But using traditional methods, you go out and you get a general idea what the valuation is. You work your institutional books so you know that you have a backstop of order flow, and then you go out to the crowd. The whole process after qualified usually takes about 60 days to close.
Last question. Good.
Let's say that you just raised through a Reg A Plus and things don't go so well in the next 12 months. What are your options?
So you completed the raise or you didn't?
You completed some raise, yeah, but it doesn't go as well as we expected.
I think that's a failure that you have to be very aware of. A lot of us, at least my opinion, I'll let somebody else address it, is that the CEO needs to understand that capital raise is part one, but now you're public and you got to now have a shareholder base you have to report to, you have to continually raise capital. And it's not the beginning, it's the end of the offering, it's the beginning of your life cycle as a public company.
Yeah, and there are some ongoing reporting obligations once you are qualified. There's a semi-annual report that you have to file, as well as certain material transactions you have to file as well. So you do have to take it very seriously. People forget, when you take money from the public, you then have a fiduciary duty to keep them informed and let them know what's happening in your company. Unlike a private placement where you can contain some of this disclosures, a Reg A plus offering is something that's going to require you to maintain those reporting requirements until you no longer meet those requirements.
So what level of a prospectus do you have to publish when you go out and start the Reg A?
So it's very defined. The Form 1A, the SEC has actually published it. You know exactly what questions you need to address and answer. But think of it as very similar to an S1 or a prospectus you see for a traditional IPO, but sort of scaled down version of it. But the disclosures about the company, the management, related party transactions, risk factors are all part of that prospectus.
And I'll just add one thing, by completing a raise, A plus Reg A raise, doesn't necessarily get you onto a stock exchange, right? So we'll see it have to be a sufficiently sized raise to meet our minimums. And generally that'll be 15 million, because that'll somewhat equate to what we call market value of public float, because you're raising them from non-insiders. So if you can get to that 15 million and a few other things, certain stock price, and a certain amount of shareholder equity, which should come, because the bankers know what to do, they know what they need to put in, get a stock price and an amount of shareholder equity, then we'll certify the 8A and then you can start trading on the national exchange. So it's not guaranteed. We still have to look to our listing standards.
There's probably hardly any companies here that are presenting that did a Reg A plus offering. I bet you this time next year, we're going to see a handful of these companies and perhaps a full track of companies that have gone through this. So the jury's out, right? I mean, the amount of deal flow is not as significant yet, but I think we're starting to finally see some traction coming out.